In the landscape of real estate investment, two primary options dominate the conversation: real estate investment trusts or REITs and traditional rental properties. Each option comes with its own unique set of advantages, challenges, and strategic considerations, making it essential to weigh their merits carefully. As we look ahead to 2025, these two investment vehicles continue to evolve, shaped by a variety of factors such as economic conditions, technological advancements, market trends, and societal changes. Whether you're an investor looking to expand your portfolio or someone considering real estate for the first time, understanding the comparative benefits of REITs versus rental properties is crucial. Real estate investment trusts, or REITs, have long been seen as an accessible way for individuals to invest in real estate without directly owning property. A REIT is a company that owns, operates, or finances income-producing real estate across a range of property sectors, including commercial, residential, and industrial properties. Investors purchase shares in these trusts, much like buying stocks, and in return, they receive a portion of the income generated from the properties within the trust portfolio. This means that REITs offer exposure to the real estate market without the need to manage the properties themselves. On the other hand, owning rental properties is a more traditional route of real estate investment, where an individual directly purchases a property to rent out to tenants. In this model, the investor is responsible for property management, dealing with tenants, handling maintenance issues, and generally overseeing the property's operations. The investor gains income through rent payments, and over time, there may be significant potential for property appreciation. When comparing these two options in the context of 2025, several factors come into play. The first factor to consider is liquidity. REITs, being publicly traded on stock exchanges, are highly liquid. Investors can buy and sell shares in REITs with relative ease, making them an attractive option for those who want flexibility and the ability to quickly convert their investment into cash. If the market conditions shift unexpectedly, or if an investor needs to adjust their portfolio quickly, REITs offer a level of flexibility that rental properties simply cannot match. In contrast, rental properties are far less liquid. Selling a property can take time, and depending on the market conditions, it may take months or even years to find a buyer willing to pay the desired price. The process is also complicated by factors such as inspections, appraisals, and negotiations. In a market downturn, it may be even more difficult to sell a property at a price that aligns with the investor's expectations. This lack of liquidity can be a serious consideration for investors who may need to access their capital quickly. Another key factor to evaluate when comparing REITs and rental properties is the level of management involved. REITs are generally passive investments. Once you buy shares in a REIT, there is little to no involvement required from the investor. The trust's management team takes care of acquiring, managing, and selling properties, handling tenant issues, maintenance, and other aspects of the real estate business. Investors simply receive dividend payments based on the trust performance. This makes REITs an appealing option for individuals who prefer a hands-off approach to investing. In contrast, owning rental properties requires much more active involvement. Property management, even if outsourced to a professional management company, still demands attention. There are tenant issues to address, rent to collect, maintenance to oversee, and potential vacancies to manage. In 2025, this could be further complicated by factors such as rising labor costs for property management services, stricter tenant protection laws, and increasing maintenance costs due to aging infrastructure in many rental properties. While some investors may enjoy the active role of managing properties, others may find the time and effort required to be a significant drawback. The potential for income generation is another critical point of comparison. REITs tend to provide steady, predictable income, especially if they focus on high-quality income-generating assets. Because REITs are required by law to distribute at least 90% of their taxable income to shareholders in the form of dividends, they are often an attractive option for income-focused investors. These dividends can provide a stable stream of cash flow, which may be particularly appealing to retirees or those seeking passive income without the hassle of managing a physical property. Rental properties, on the other hand, offer the potential for both cash flow and long-term capital appreciation. Monthly rental payments provide a consistent income stream, though the reliability of that income can vary depending on tenant turnover, rent payment histories, and local market conditions. In addition to rental income, property owners can also benefit from potential appreciation in the value of the property over time. If the property is located in an area that experiences growth, such as a booming urban center or a rapidly developing suburb, the value of the property may increase significantly. However, there are also risks associated with property value fluctuations, and investors may be impacted by local market downturns, zoning changes, or shifting demand. In terms of risk, both REITs and rental properties have their own set of advantages and challenges. REITs offer diversification, which can reduce individual risk exposure. By pooling capital from a variety of investors and investing in a portfolio of properties, a REIT helps to mitigate the impact of any single property's performance on the overall portfolio. This diversification is especially valuable in the context of real estate markets that may experience volatility or regional downturns. For example, if a REIT's portfolio includes both residential and commercial properties across different geographic regions, the poor performance of one sector or area can be offset by the success of others. However, REITs are also subject to market risk. Like stocks, the value of REIT shares can fluctuate based on broader economic conditions, investor sentiment, and interest rate movements. When interest rates rise, for instance, REITs can face challenges as higher borrowing costs can decrease profitability for real estate owners. Additionally, during economic downturns, the demand for real estate may decrease, leading to lower rental incomes or higher vacancy rates for the properties held by the REIT. Owning rental properties also carries inherent risks, particularly related to property damage, tenant disputes, vacancies, and unforeseen maintenance costs. For example, an unexpected roof leak or appliance failure can result in significant repair costs. While insurance can mitigate some of these risks, property owners are still responsible for ensuring the property remains habitable and compliant with local regulations. Vacancy rates can also be a concern during periods of economic uncertainty. It may be harder to find tenants, and the income from the property may be inconsistent. One of the most significant advantages of owning rental properties in 2025 is the potential for equity growth. As a property owner, mortgage payments build equity over time. If the property appreciates, the equity can increase substantially, creating long-term wealth. For investors who plan to hold properties for many years, this equity buildup is a powerful tool for creating wealth. By contrast, REIT investors do not build equity in the same way. While REITs provide income through dividends, they do not offer the same opportunity for principal reduction or appreciation tied directly to the ownership of physical assets. In 2025, technological advancements will also play a role in shaping the future of real estate investing. REIT, with their reliance on digital platforms for transactions and transparency, are well positioned to take advantage of advancements in data analytics, property valuation models, and market forecasting tools. These tools can help REITs optimize their portfolios and better predict market trends, which can enhance overall performance. Rental property owners, however, may also benefit from technology. Property management software has evolved dramatically, making it easier for landlords to track rent payments, manage maintenance requests, and communicate with tenants. In addition, advancements in smart home technology allow property owners to improve energy efficiency and reduce costs, which can be particularly appealing to tenants. Digital platforms for advertising, leasing, and payments also make it easier to manage rental properties and reach a broader audience of potential tenants. The economic landscape of 2025 is likely to be shaped by a variety of factors, including inflationary pressures, changing interest rates, and evolving work-from-home trends. These factors will affect both REITs and rental properties in different ways. For example, if inflation continues to rise, rental properties may benefit from higher rent prices, especially in areas where demand for housing outpaces supply. On the other hand, REITs may face challenges if rising costs impact the profitability of their real estate holdings. Ultimately, deciding between REITs and rental properties comes down to your personal investment goals, risk tolerance, and level of involvement you're willing to have in your investments. If you are seeking liquidity, passive income, and diversification without having to manage physical properties, REITs may be the better choice. However, if you are looking for long-term equity growth, control over your investments, and are willing to take on more responsibility, rental properties could provide greater rewards. In 2025, the decision will likely hinge on broader market trends, individual financial goals, and personal preferences. Both REITs and rental properties offer unique advantages, and neither is inherently better than the other. By understanding the trade-offs, diversifying your approach, and aligning your investment strategy with your long-term objectives, you can make an informed choice that sets you up for success in the ever-changing world of real estate investing. When it comes to passive versus active management, the distinction between REITs and rental properties becomes quite evident. REITs by nature are designed as passive investments. Investors in a REIT buy shares of the trust and, in return, earn dividends based on the performance of the underlying properties in the portfolio. The management team of the REIT handles all aspects of the real estate business, from property acquisition and management to leasing and maintenance. As a result, REIT investors do not need to deal with day-to-day property issues, tenant concerns, or the intricacies of real estate operations. This hands-off approach makes REITs an attractive choice for those who want exposure to real estate without dedicating significant time and effort to property management. It's particularly appealing for individuals who are looking for a more passive, income-generating investment that doesn't require frequent attention or intervention. On the other hand, owning rental properties is a much more active investment strategy. Property owners are directly involved in the management of the property, which includes dealing with tenants, maintaining the property, handling repairs, collecting rent, and responding to legal or regulatory issues. While some property owners may hire a management company to assist with these tasks, the ultimate responsibility still falls on the property owner. Managing a rental property requires consistent attention to ensure tenants are satisfied, rent is collected on time, and maintenance issues are addressed promptly. For some investors, this active involvement can be a rewarding challenge, allowing them to increase the property's value through improvements or by managing it in a way that maximizes rental income. However, for others, it can be time-consuming and stressful, especially if unexpected issues arise, like vacancy periods or costly repairs. Liquidity and accessibility are two crucial factors that heavily influence an investor's choice between REITs and rental properties. REITs provide an attractive level of liquidity because they are publicly traded on stock exchanges. This means that investors can buy and sell shares in a REIT with the same ease as trading stocks, making it simple to enter or exit an investment quickly. In a volatile or fast-changing market, the ability to liquidate holdings in a REIT without delays offers significant flexibility. For instance, if there is a sudden shift in the market or a personal need to access cash, an investor can sell their REIT shares almost instantly during market hours, ensuring they can respond to changing financial circumstances. This level of liquidity is a key reason why many investors prefer REITs for short-term goals or more dynamic portfolio management. In contrast, rental properties are considered illiquid assets. Selling a property typically takes much longer and can be subject to a variety of factors that make the process unpredictable. The timeline for selling a rental property can range from several months to a year, depending on the real estate market, location, and the price point of the property. Additionally, the process of selling involves several steps, such as hiring a real estate agent, staging the home, negotiating offers, and dealing with inspections and appraisals, all of which can add time and complexity. On top of that, transaction costs such as agent commissions, closing fees, and potential repairs or renovations can reduce the net proceeds from a sale, further decreasing the accessibility of the capital tied up in the property. Therefore, real estate investors who own rental properties may face challenges if they need to access their funds quickly. The relative illiquidity of rental properties makes them better suited for long-term investors who are comfortable with their assets being tied up for extended periods. Wealth building and control are two areas where rental properties and REITs diverge significantly, offering distinct advantage depending on an investor's preferences and objectives. One of the primary benefits of owning rental properties is the opportunity for long-term wealth creation through both rental income and property appreciation. When you own a rental property, you build equity over time by paying down the mortgage, and as the property potentially increases in value, your wealth grows as well. This combination of equity buildup and property appreciation can result in substantial financial gains over many years, particularly if the property is in a high-demand area or a market that experiences rapid growth. Additionally, rental income from tenants can provide a reliable stream of cash flow, which, if managed wisely, can be reinvested into other properties or investments, further compounding wealth. In contrast, REITs do not offer the same opportunity for equity growth. While REITs do provide consistent dividend payments to shareholders, their value is primarily tied to the performance of the properties within their portfolio, not the direct ownership or appreciation of physical assets. As a REIT shareholder, you don't have the opportunity to make decisions that directly influence the value of individual properties, such as renovating or optimizing rental rates. The returns you earn are based on the overall performance of the trust, which is influenced by factors outside your control, such as the trust's management decisions, market conditions, and interest rates. However, the control factor is where rental properties shine. As the owner, you have complete autonomy over key decisions, such as setting rental rates, selecting tenants, making property improvements, and handling maintenance. This control can enable savvy investors to maximize their return on investment by adjusting to market conditions or improving the property's value. REIT investors, on the other hand, lack this direct influence, relying entirely on the management team to make decisions that impact the fund's performance.